Good morning, students. I'm Margot Scott, and today I would like the opportunity to go with you through the mark-to-market reserve on consolidations. From prior experience, we know that most of the students don't grasp the concept, but I want to break it up today into smaller pieces that you can understand how to treat each component in the consolidations, and I think then it will be easier for you guys to understand. So let's start. The big question that everybody's asking is, what is mark-to-market reserve? It is linked to the investment in shares. So investments in subsidiaries, investments in associates or joint ventures, or investments in normal shares, where you buy listed shares, for example, a Sasol share. The mark-to-market relates to a specific valuation of those shares. The fair valuation of investments that is treated through other comprehensive income and then taken to a separate equity reserve, which is called mark-to-market reserve. The fair value adjustments on the investments are recognized directly in other comprehensive income section of the statement of profit and loss and other comprehensive income, and thereafter it is transferred to equity in the statement of changes in equity in the column which is only called mark-to-market reserve. Basically, if I can explain it, it works more or less the same than as your investment in property, plant and equipment, where property, plant and equipment, if it's revalued, the fair value adjustment is taken to other comprehensive income, and from there it is transferred to equity in a reserve called revaluation surplus. So mark-to-market reserve is the same principle as revaluation surplus, and you will treat it in exactly the same way. So where do we start? We start with the classification of the different types of investments. You'll have a normal investment, which will be things like Sasol shares, or shares where you have a very small interest in the company itself. So it's normal investments in companies, okay? We have 4 different categories to classify those. It is classified as a financial asset, and there's 4 categories to measure that for accounting purposes. We're only going to look at 2. So in the next slide, I will show you the different measurements, and we'll speak about those. Then you have your investment in associates or joint ventures. This is where an investor has significant influence or then joint control over the financial or operating policy decisions of that company. We account for those investments in accordance with IAS 28, and we use the equity method for that. Then you have the third classification, which is the investment in subsidiary. This is where the investor normally has control over the financial and operating policy decisions. For these investments, we account them in accordance with IFRS 3 business combinations, where we start with the at acquisition, the since acquisition, and you account for your interest in that company. Okay? The treatment of the types of investments in the consolidated statements. This is where we apply the consolidated accounting. If you have investments in subsidiary, and those investments are valued at fair value through other comprehensive income, you have to reverse the fair value adjustments to take the investment back to cost price, because as soon as you start consolidation, you start with the consideration that you paid for that investment. Otherwise, you will overstate or understate your goodwill or gain on bargain purchase. For the investment in joint ventures or associates, you also reverse the fair value adjustment because we apply the equity method. And for the equity method, we start with the cost price of the investment. The normal investments in equity instruments, those investments are part of the net asset value of that company. Those we want to be at fair value for IFRS 3 purposes. So those investments, the fair value adjustments on those investments will not be reversed. It will remain in your accounting records, and you will treat each item accordingly. Okay, there are 2 classifications for the normal investments. Remember we said there's a category for the financial assets. There are 4 classification categories. We are only going to look at the 2 that we use most often. So it's investments that are measured at fair value through profit and loss, And you will see in your study guide on page 17 to 19, there's an illustration 1 and 2 that will show you how it's treated at fair value through profit and loss. For those investments, the fair value adjustment merely goes to the profit and loss section through either other income or other expenses. The second category is where investments are measured at fair value through other comprehensive income. And you can look in your study guide on page 20 to 22 for illustration 3 and 4 to show you the treatment of the investments at fair value through other comprehensive income. This is also what we are going to look at in this presentation for consolidation purposes. Okay. In this example, you can see there's two companies. It's Nemo Limited, which is the parent, and there's Dory Limited, which is the subsidiary. So if you start, I want you to immediately look at your trial balance. You will see mark-to-market reserve. If you see that, you must immediately know that the investments are valued at fair value through other comprehensive income. But now what we're going to do is you're going to identify, you're just going to start with the one company. So we're going to look at Nemo Limited first, and then we will look at Dory Limited secondly, and we will break the line items of the trial balance into components to see how we treat those, and then we will move forward. So from the information here, you can see there's mark-to-market reserve and other comprehensive income, the fair value adjustments on the investments in equity instruments. So there you can see immediately which fair value method the company is applying to measure those investments. Okay, and this is the second part of the trial balance of the assets and the income and expenses. So there you can see this is the investments that we are looking at in this company or in this consolidated statements, and we have to account for those. But before we start with that, you first need to determine in whose books are those investments, and then we need to classify them. So in this one, it's in the parents' books, it's only Dory and Fluke Limited, and in Dory Limited, it is only the investment in Rudder Limited. So let's look at the additional information. We say that Nemo acquired control over Dory Limited on the 1st of March 2014. There we know the investment in Dory Limited is a subsidiary, and we need to account for that in accordance with IFRS 3. The second part of the information is just the at-acquisition reserves, which we'll need for the at-acquisition elimination journal. If we look at the second slide, it says that Nemo acquired its interest in Fluke Limited on the 1st of April 2014, and the cost price of that investment was 180,000. Okay, then it goes further. It tells you the types of investments in the books of Dory Limited, the parent, and it will show you it's got the investment in Dory and in Fluke. Here I'm giving you the cumulative fair value adjustments, and I'm giving you the period in which that fair value adjustments arose. So if you look at the information, all the fair value adjustments arose in the prior years, nothing in the current year. Okay. In the second slide, I'm giving you the accounting records of the subsidiary, Dory Limited, and they have an investment in Rudder Limited. I'm also giving you the fair value adjustments on that investment in the period. So prior periods, there was nothing, and in the current period, the fair value adjustment was 13,000. So we will need this to move forward with our accounting. Okay. There's a few other information, just the normal information. Okay, there was an intergroup loan, which you'll not need for this example, and there was non-controlling interest that was measured at fair value on acquisition date. So you'll need this information for your at acquisition elimination journal. Then they tell you that the tax rate is 28% and that the capital gains inclusion rate is 80%. Okay. Then we start. We only look at the investment in the parent's trial balance. So we're only going to focus on the trial balance of the parent. Then we'll move forward to the trial balance of the subsidiary. So what is important here is it's that only the two investments, it's Dory Limited and Fluke Limited. We already classified Dory Limited as the subsidiary and Fluke Limited is the normal investment. In the second slide, we will look at the parent's trial balance and we need to identify the mark-to-market reserve or the other comprehensive income. So this is the period in which the fair values arose. And then together with that, the deferred tax liability that arose due to the revaluation. So in the books of Nemo Limited, you can see that the mark-to-market reserve, all the fair value adjustments was done in the prior year. And then you have the deferred tax liability, and there was no fair value adjustments in the current year. So that corresponds with the table that we saw in the previous slide. Okay. So we need to first break up we need to break the trial balance up into different components. This is to make it easier. So in the trial balance, you'll see there's the investment in Dory Limited and Fluke Limited. What is this? It's classified as assets. How do you disclose the assets in the consolidated statement of financial position? It is disclosed at 100% for the parent. And because Dory Limited is the subsidiary, we need to eliminate the investment in Dory Limited with the at acquisition journal entry. Therefore, if you look at the assets, Fluke Limited is a normal asset, so that will be included at 100%. Dory Limited has fair value adjustments, but for IFRS 3 purposes, we want to reverse those fair value adjustments. So we will first reverse the fair value adjustments to take it back to consideration, and then we can start with our at acquisition journal entry. The second component in the trial balance is the deferred tax liability. Okay, this is a normal liability that's created due to the revaluation of that investment. Okay, so this is a normal liability. We'll go through the tax implications in the next slide. Then I'll explain to you what happens with the revaluation of those investments. But for now, you just need to know it's classified as a liability. And how do I account for a liability? I include 100% of the parent in the statement of financial position. The mark-to-market reserve is the second component, and that is classified as equity. And this is disclosed in the consolidated statement of changes in equity of the parent at the 100% of the parent's interest. Okay, then we have other comprehensive income, which is classified as income, and we disclose this as 100% in the consolidated statement of profit and loss and other comprehensive income. Okay, then we first need to look at the classifications of the different investments in the trial balance of Nemo Limited. So the first one was the investment in the subsidiary Dory Limited. We said we're going to reverse the fair value adjustments, and then we're going to process the at acquisition journal entry. The other investment is the investment in Fluke Limited. We will not reverse the fair value adjustment, and it will remain in the consolidated statements as is. We will just break it up into the different components and treat those accordingly. Okay, so what happened in the separate financial records of Nemo Limited? It first acquired its interest in the subsidiary, Dory Limited. So they processed the journal. The journal entry will be debit the investment in Dory Limited at cost price, 390,000. Credit bank, 390,000. And from there, they applied the fair value measurement through other comprehensive income. So after that, we saw that the fair value adjustment arose in the prior year. So they said debit the investment in Dory Limited with 5,000 Rand. Credit the deferred tax liability that was created due to the revaluation of 1,120 Rand. Credit the mark-to-market reserve of 3,880 Rand. It is prior year, so it will go to the equity reserve, mark-to-market reserve, not other comprehensive income. That's only if it arose in the current year. Okay, due to the revaluation of the investment, I just want to show you that the investment is the asset. It was revalued, so the carrying amount was the fair value and the tax base is still the cost price. So there was a timing difference that was created due to the revaluation. And if you look at the component of the asset where the carrying amount exceeds the tax base, a deferred tax liability is created. The next important thing is to notice is that it's an investment in shares. So it will trigger the capital gains tax and not the normal income tax rate. So please use the CGT rate for the timing difference. Okay. In the consolidated accounting records, the investment in Dory Limited, the first step is to reverse the fair value adjustment. So we saw in the previous slide that the fair value adjustment was in prior years, so we will reverse it against mark-to-market reserve. And we need to reverse it back to the cost price. So we'll start by debiting the mark-to-market reserve, which is the equity reserve. Please note that it's after tax because it's the equity account. Then we debit the deferred tax liability that was created due to the revaluation. So we reverse that liability. And we credit the investment in Dory Limited with 5,000 Rand. Now we are back at the cost price for that investment at 390,000. Step 2 will be to eliminate your at acquisition equity against the investment in the subsidiary. So you can go and look at this journal entry. So I just want to indicate what's important here is that you want to reverse the investment at the cost price, the consideration, and not the fair value of 395,000 Rand, because otherwise you will overstate or understate your goodwill. Okay. So for the next slide, we are left with the investment. Now we need to disclose these. Okay, the investment we said was the asset. So the investment in Dory Limited, we know we have to reverse the fair value adjustments, and then we have the elimination at acquisition date of that investment. So there will be nothing left of the investment in Dory Limited in your statement of financial position. Then we look at the investment in Fluke Limited. This is a normal investment, which is an asset. For a parent, we include 100% of the parent's asset. So therefore, we include 200,000 of that investment in Fluke Limited at fair value. Okay. Then we look at the deferred tax liability. I know it's deferred tax, but look at it as a liability. It's classified as a liability. How much do I include of the parent? 100%. Remember, we also reverse the fair value adjustment, and with that, we also reverse a portion of the deferred tax on that investment in Dory Limited. So you will need to take that into account. Then we have to look at the equity. The equity of the parent, which is the mark-to-market reserve. If you look at the mark-to-market reserve, it relates to the two investments in that trial balance. It relates to the investment in Dory Limited and the investment in Fluke Limited. From the previous journals, you saw that we need to reverse the fair value adjustment on Dory Limited with this journal entry that we wrote to just refresh your memory. And we will be left with only the mark-to-market reserve relating to the investment in Fluke Limited. That mark-to-market reserve we will not eliminate. Okay, if you look at the disclosure, you will have to include in the opening mark-to-market reserve, you'll have to include the 15,520 of Fluke Limited. So you will disclose 15,520 in your opening, because it's 100% of the equity of the parent and it's prior year. Okay. Then we look at the disclosure of the other comprehensive income. In this example, there was no current year fair value adjustments for the parent. So if you look at your statement, at the top you'll have your profit and loss section, and at the bottom you'll have your other comprehensive income section. And in here we start with the fair value adjustments on the equity investments, and you will include 100% of the parent. Remember, we will take it to the mark-to-market reserve, which is the after-tax amount. Therefore, we need to include the tax effect here as well. So for the parent, you include 100% of income with 100% of the tax effect. But in this example, it was 0. So then we move to the since acquisition of the mark-to-market reserve, and there you will see it was the 15,520. So you will disclose it as mark-to-market reserve 15,520 here, and because in the current year there was no fair value adjustments for the parent, you will include 0. It was nothing. But if there was an amount, you will include 100% of the parent's amount, but the after-tax figure. Okay. If we look then at the trial balance of the subsidiary, we also need to identify the components. So we first start with the types of investments. So in the Indori Limited's trial balance, there was only the investment in Rather Limited, which is a normal investment. So we will not reverse the fair value adjustments, and it will remain in the statements at fair value. So in the second part of the trial balance, it will show you the deferred tax liability that was created due to the revaluation, as well as the mark-to-market reserve. All the fair value adjustments arose in the current year, therefore nothing will be recorded in the prior year. Then you will look at your other comprehensive income, and you'll see that there was the fair value adjustments net after tax that was recorded on the investment in Fluke Limited, in Rather Limited. Okay. So for the mark-to-market reserve, which is the equity component, we have to look at the timing of that reserve. So at acquisition date, if you have mark-to-market reserve, it will be eliminated in the at acquisition pro forma journal entry. If you have since acquisition mark-to-market reserve, you will split it between the parent and NCI in the same way that you will account for retained earnings. This represents equity, and we will account for it in accordance with the parent's percentage interest. Okay. If you look at the other comprehensive income, which is the current year period, you will account for it in the top of the statement in the other comprehensive income section as 100% of the fair value adjustment on the investment in shares. And you will take into account the tax effect, but please note that it's 100% of the subsidiary's percentage. And at the bottom, before it goes to your equity account, you split that income, that other comprehensive income, between the parent and the NCI. And from there, it is transferred to the mark-to-market reserve in accordance to the subsidiary's interest. Okay. If you look at the different components in the trial balance, it represents the investment in Rather Limited, which is the asset, and we include 100% of the assets of the subsidiary in the consolidated statement of financial position. If you look at the deferred tax, this is classified as a liability, and we disclose 100% of the subsidiary's liability in the consolidated statement of financial position. If you look at the mark-to-market reserve, this represents equity of the subsidiary, and we disclose only the parent's percentage interest of the equity. But in this example, there was no mark-to-market reserve in the prior year periods, so it was zero for the subsidiary. Then we look at the other comprehensive income, which is classified as income, and we disclose 100% of the income of the subsidiary in the consolidated statement of profit and loss and other comprehensive income in the other comprehensive income section of that statement. Okay, so if we start with the assets and liabilities of that subsidiary, we will see it's the investment in Rather Limited, which is a normal investment, and it's an asset, so we include 100%. So I disclose the investment at fair value, 100%. Then there was a deferred tax liability related to that revaluation of the investment in Rather Limited, and this is classified as a liability, so I will include 100% of the subsidiary's liability, 2912. Okay. Then we will look at the at acquisition journal entry. If you look at the investment in Rather Limited, it's part of the net asset value of that company, of the subsidiary. And we look at equity at acquisition date because it represents a summary of the net asset value. In this example, there was share capital and accumulated loss. So this represents your net asset value of the subsidiary at acquisition date. Please note that there's no at acquisition mark-to-market reserve on the investment in Rather Limited. So I will not need to eliminate any portion of that. I will eliminate against the cost price, the consideration for that investment. Okay, then we move to the since acquisition equity of the subsidiary, which is the mark-to-market reserve. So this will represent the movement in the mark-to-market reserve from at acquisition to the beginning of the current year. And that equity investment we split between the parent and NCI. In this example, there was no mark-to-market reserve since acquisition date, so we will not have to do the split to take out the NCI's interest in the mark-to-market reserve to account for that mark-to-market reserve at the percentage interest of the subsidiary, which will be 90%. So if we look at the calculations, we did the calculation of the mark-to-market for the parent in the previous slides. So now we have to look at the mark-to-market reserve for the subsidiary. So there was an opening balance which was 0, but if you had a balance, you'll include the balance. You will eliminate any at acquisition mark-to-market reserve from that balance, and that will give you the movement in the mark-to-market reserve of Dory Limited. And that movement, you will only include 90% of that in your opening mark-to-market reserve. So if you look at your opening balance for mark-to-market reserve, in the previous section we included 100% of the parent, which is 15,520, which related to the investment in Fluke Limited, and we will include 100% of the subsidiary, but there was nothing, so we include 100% of 0, and we will disclose it as opening mark-to-market reserve. Then we will look at your current year other comprehensive income. This is disclosed for the subsidiary, so we include 100% of that income for the subsidiary in the other comprehensive income section of my consolidated statement of profit and loss and other comprehensive income. At the bottom of that statement, we will split the total comprehensive income between the parent and NCI before it goes to the equity reserve. Because equity we want represented 90% of that subsidiary. And we take the other 10% we account to NCI. So if I can just show you this in the statements. So we include 100% of the other comprehensive income of the parent, net after tax. So this is the 13,000 fair value adjustment. The after tax amount we will include 100% of the subsidiary, but from here it needs to go to my equity reserve. So it will go to my statement of changes in equity. But now we have a problem because the subsidiary is included at 100%. And we need to split this amount between the parent and the NCI. So at the bottom of my statement I will show you. This is where you split it between the parent's percentage and the non-controlling interest percentage. So in here I allocated the mark-to-market reserve in the current year that related to the non-controlling interest. So I'm taking 10% of the other comprehensive income and I'm allocating it to my non-controlling interest column. And the rest that remains will be 100% of the parent and then 100% or 90% of the subsidiary, and we will disclose that in mark-to-market reserve. Okay, so if you look at the journal entry, this is where I write my journal to take out the percentage of NCI in that other comprehensive income of the subsidiary and allocate to the non-controlling interest. Okay, then we will look at the disclosure. So in the current year, we look at other comprehensive income disclosure. Mark-to-market reserve is the equity reserve, so we can only account for the subsidiary's percentage interest, which is 90%. So that is the 9079, and we account for NCI's interest in the other comprehensive income of the subsidiary as at 1,009 Rand. So this is disclosed then correctly. Equity represents 90% of the parent, of the subsidiary and 100% of the parent. So this is then correct if you look at the components. Okay, so if you have any questions, please send us an email or phone us and we are more than willing to assist you with any of your queries. Just to recap quickly, so if the investment relates to a company within the group, then the rule is that we reverse that fair value adjustment to take it back to cost price, because if it's a subsidiary, we apply IFRS 3 and we want to get back to the consideration at acquisition date. If it's on the investment of an associate or a joint venture, we apply the equity method. And for consolidation purposes, we start from the cost price of that investment. So we also need to reverse the fair value adjustments on those. Then the easiest thing is to break it up into the different components that it represents. The investment is the asset. Then you ask yourself, how do I treat the asset? And you account for it in the parent's records and in the subsidiary's records. The second one classification is the liability, which is the deferred tax liability. You ask yourself, in whose records is it, the parent or the subsidiary, and you account for it in accordance to the rules. 100% for the parent, 100% for the subsidiary. The third category is the equity, which is the mark-to-market reserve. The equity of the parent, the mark-to-market reserve, is included at 100%. The equity of the subsidiary is included at their percentage interest, which in this example was 90%. The fourth category was the other comprehensive income. Now this represents income. We need to disclose 100% of the income of the parent and 100% for the subsidiary. Remember that it's only at the bottom of the statement that I take out the NCI's percentage interest and allocate to their shareholding. And from there it's transferred to the equity account mark-to-market reserve, and it represents the 100% of the parent and 90% of the subsidiary. Okay, I hope this helps you with your studying, and good luck.